Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former senior executive at Hess Oil for over 2 decades. I think he's worked over 3 decades in the oil and natural gas industry. He was involved in mergers and acquisitions in their department at Hess Oil for a long time. He writes the Energy Prospectus Group newsletter and hosts luncheons with a lot of oil and natural gas companies out of Houston, Texas. Dan Steffens, thank you for joining me again.
Yeah, thanks for having me. I'm up to 4 decades now in the industry. So
you're a wealth of knowledge for oil and natural gas. There are very few experts out there with as much experience as you have in one specific sector.
Yeah.
So I want to get your insights here on what's going on. We're just seeing tons of news stories, press releases back and forth. It's getting a game of drama. It's drama queens here from the Biden administration and OPEC Plus. You have these enormous OPEC Plus production cuts that were announced. What is it, 2 million barrels per day? And then you have the Biden administration announcing that they want to dump even more strategic petroleum reserve oil to try to counter that, to manipulate prices down, after they were begging the Saudis. I think last night I just saw stories to not cut oil production.
Yeah, it's just amazing to me how the level of ignorance they have about the total global energy market, and especially the importance of oil to the civilized world. I mean, you can wish it as much as you want to go away, but this world runs on oil. It specifically runs on diesel. There's a global diesel shortage because we lack the heavy oil we need to make it. And, you know, this stuff about trying to pull oil out of the strategic petroleum reserve to manipulate gasoline prices before the next election. I mean, it's a blatant political move, and I don't get it. And the thing is, with the OPEC announced cuts, I went back and looked, and they have, for at least the last 12 months, produced significantly below their official quotas. And the last month I have actuals for was August, and they were more than 3 million barrels a day below their actual forecast. So what they're really doing is just adjusting their official production forecast to what they can actually produce, because 2/3 of the OPEC countries are on decline. Nigeria and Angola are way below what their quotas are, and there's no way they can make it up. And obviously Saudi Arabia doesn't want to, ramp up production to sell it at low prices just to help Joe Biden get elected. They do what is in their best interest, and their best interest is to get a fair price for their oil production.
Yeah, and if oil keeps falling, I mean, from what we're seeing with a lot of these oil companies and their announcements in the Q2 numbers, Diamondback Energy announced that their drilling costs to drill a new oil and natural gas well onshore, I think in the Permian, were up 15% year over year. I've interviewed other oil and natural gas experts, and they said that was on the low end. So costs are rising. If oil prices fall, I mean, a lot of these companies are not going to have good profit margins.
Yeah, well, they're going to have good profit margins on the wells they have already drilled. The thing is, this is like saying, if you already own a home and the cost to build a new home have gone up 15, 20, 25%, well, then that makes your existing home more valuable. So the companies like Diamondback that have a whole bunch of wells already drilled that they drilled and completed for much lower prices than we have today, those are extremely valuable companies. So you want to invest in companies that already have a lot of production. Now, if you're a startup or something, and you need to build your production to justify being public, yeah, you're kind of in trouble because the well cost. But still, I mean, at $80, $90 oil, these companies are still making a lot of money. I could tell you that. And I've looked at some small ones today, and they really look good. So,
what type of profit margins and cost increases do you have? So do you have then costs are up, more than 15% year over year? So Diamondback's on the low end, but you still have profit margins at $20, $30, $40 a barrel for a lot of these oil and natural gas producers?
Yeah. Okay. Operating companies for most of the companies, actual cash operating costs are in the $12 to $15 a barrel range for most of the companies. Okay. Now, that does not include what it costs them to drill and complete the wells. And these horizontal wells in the big shale plays, they cost $8 to $10 million. Now they had gotten more efficiency, and their cost per foot had gone way down. The big problem this year is lack of tubulars. The supply chain problems that we talk about, baby formula and all this stuff. In the oil field, the problems they're having is finding the tubulars, number one, frac sand, the chemicals they need to complete the wells, and also people. With the COVID pandemic really ran a lot of good people out of the business, and the oil field service companies are having trouble ramping up to meet demand. That's why we're still way below. Everybody thought that as soon as COVID-19 was over and the restriction, that our production would bounce back to 13 million barrels a day, and we're still below 12 million barrels a day. So we're not even close to where we were pre-pandemic. And I don't know if we'll ever get there. The one thing that your listeners need to understand is these shale wells come on strong. They produce about 30% of the oil they'll ever produce within the first year, and then they go on decline. So our depletion rate, our decline rate on the total wells that we have in the United States is getting steeper and steeper. So we have to drill and complete more wells every year just to keep production flat. And so getting back another million barrels a day of current production is going to require a lot more drilling rigs than we have operating today, and a lot more completions. And, eventually you do run out of the tier 1 acreage in a lot of these plays. I really think the only oil play that has a lot of upside for us is the Permian Basin, and it does have a lot of upside.
Yeah, the Permian has a lot of sweet spots. It's also the lower cost. It looks like the other shale basins. So what, Haynesville is peaked.
Haynesville is gas. It's almost pure gas.
Oh, is that the one in Dallas, Texas, or am I thinking of another one?
No, you're thinking of for an oil base. Are you thinking of Eagle Ford, right?
Yeah, I think Eagle Ford.
Yeah, the Eagle Ford is an oil. The Eagle Ford play is much smaller than the Permian Basin. So the big oil basins are the Bakken up in North Dakota. That's really the Williston Basin and the Bakken Formation. You've got the DJ Basin in Colorado. The big Kahuna is the Permian Basin in Texas and New Mexico, and then in South Texas is Eagle Ford. And then, got some stuff up in Oklahoma, Scoop Stack that's still pretty good. Now, on the natural gas side, the big one is the Marcellus Shale play up in Appalachia. That's Pennsylvania, Ohio, West Virginia. And their problem is they don't have enough pipelines. Our governments, federal, state, local, everybody seems to protest every pipeline that ever gets attempted to be built, and they are now they're kind of landlocked. They're waiting. That pipeline that Joe Manchin wanted approval for, it's the Mountain Valley Pipeline, that still hasn't been completed, and they need to get that completed so they can increase the gas coming out of Pennsylvania and West Virginia. And then, of course, you mentioned the Haynesville. The Haynesville probably has the most upside from a natural gas play because its location, it's close to the Gulf Coast where all the LNG export facilities are.
Didn't EQT just buy about $5 billion worth of natural gas assets in the Marcellus, and then they're trying to build those pipelines? So EQT, I think, is one of the largest pure natural gas plays in the United States, and they're trying to invest more in the Marcellus Shale.
Yeah, it's the biggest natural gas producer in North America by a wide margin, and it just got bigger. It produces about 6-7 BCF, billion cubic feet a day. So that's about 6 or 7% of our total production from that one company.
Now, you mentioned oil service companies and the lack of drilling. Schlumberger released their Q2 numbers, 6 weeks ago, and they were really ugly. They were cash flow negative, still paying a dividend. It looks to me like they need to raise prices substantially to fix their cash flow problems and maintain their dividends. So do you think the oil service companies, the companies that do the drilling that get hired by the exploration and production companies, they're going to have to raise prices substantially? They're going to have to fix their cash flow problem and their profit margins.
Yeah, they cut their prices during the pandemic, and now they need to raise them to get back to normal. But from an international standpoint, Schlumberger is in really good shape. So the big oil field service companies are Schlumberger, Halliburton, Baker Hughes, and they're solid, and they'll have their profits back up again.
Are the mid-tier oil service companies, are they more efficient than the larger ones right now? Are they not having the cash flow negative problem that Schlumberger is?
Yeah, I really don't follow that subsector that much. I have one that I really like. It's Solaris Oilfield Infrastructure. They're a very disciplined company. They are debt-free. They are the leader in frac sand management at the well site. They have this equipment, these vertical silos, and they handle frac sand and chemicals for completing wells. And they have gained a lot of market share because a lot of their competition went out of business. But they are very profitable. They pay a nice dividend, and they're back in growth mode. I just published a report on them the other day. I really like them, but I don't follow the big oil field service companies, so I really can't comment on those. So I follow some midstream companies that are primarily upstream companies.
Do you think that there's potentially going to be a natural gas shortage either in the U.S. or globally over the next 6 to 9 months? Now, I know the U.S. has been increasing natural gas production, but our plan is to here in the United States, the plan is for more firms to export more liquefied natural gas to Europe, Asia, and other emerging markets. So do you think then that there's going to be a global natural gas shortage over the next couple of years?
Well, there's definitely a global shortage. I mean, Europe is in big trouble because the bombing of those two Russian pipelines, Nord Stream 1 and 2, that totally cuts them off from Russian gas, and they were dependent on Russian natural gas for about 30 or 40% of their supply. So now they are just begging for more LNG, to import more LNG from both the United States and Australia, elsewhere. But the price of natural gas in Europe is about 8 or 10 times what our price is, where we're paying $6, $7 in MCF. For natural gas, they're paying like $40, $50, $60 per MMBTU over in Europe, and they are definitely going to be short. Without the steady gas flow from Russia, they're in big trouble, and the gas they have in reserve right now will probably run out sometime in February, and they are already telling people. I read a report from Sweden today. They are telling people to stock up on firewood, to be ready to huddle around their fireplace when it gets really bad, and to actually make plans to bring like their family to all sleep in one room and stuff like that. I mean, it's really crazy, desperate stuff, but that's what happens when you rely on one country for your supply. They need diversity of supply, and their move to this green energy, wind and solar stuff, they did it too fast without really understanding how poor it was going to be. But in the United States, we're going to start the winter with our natural gas in storage about 10% below normal. And if we do have a very cold winter, it could get very, tight. What you see now is, gas prices have gone from $2 and $3 and MMBTU in the United States to now they're 6 or 7. We actually had a spike to $10 recently. I think we could see $10 natural gas again by the end of the year. I am very bullish on the natural gas companies. Natural gas is a totally different market than oil. It is a regional market. We do have export capacity, but we are blessed to have abundant supplies of natural gas and NGLs in the United States. And so, but we are now export quite a bit. We export like 12 billion cubic feet per day, or about 12% of our total supply. And that's going to ramp up to about 14 billion cubic feet a day here in another month when Freeport. We had a big fire down here in South Texas at one of the large LNG export facilities, and it's been shut down since June, but it's scheduled to come back on late in November and ramp up quickly to 2 BCF a day. And then we have some more LNG facilities coming online in the next couple of years. So we're going to our natural gas price should move closer and closer to an energy equivalent with oil. So 1 barrel of oil has 6 times the energy that's in 1 MCF of gas. So gas should sell on an energy equivalent basis at 1/6 oil price. So if you had a $90 oil price, natural gas should be about $15. And an MMBTU. And I think we could move close to that if we have a very cold winter.
I've interviewed other oil and natural gas experts, including top oil hedge fund manager Josh Young recently, and he was saying how the profit margins for oil wells are much better than natural gas. Do you agree with him, or do you think that the natural gas companies, like you said, that their profit margins are going to be robust going forward compared to maybe producing oil wells?
Well, at $6-7 in MMBTU, they're doing really well. They've made tremendous progress. We were stuck in an oversupplied market in the United States for about 14 years. And now we're kind of in an undersupplied market. And I don't think we're ever going to go back to this $3-4 range for gas. I think the new floor for natural gas is probably going to be in the $5-6-7 range. I just got a detailed report from Raymond James, and their prediction is that natural gas will average $7 per MMBTU in the United States next year. And that's just if we have a normal winter. If we have which we have a La Nina winter coming again, they're usually cold in North America. If we have a colder than normal, or even if we have the same winter we had last year, I think you could see double-digit natural gas prices, definitely in February and March. And if we deplete our gas in storage by the end of the winter, you have to refill the storage before the next winter. And therefore, you'll be in competition with the LNG exporters. So there's going to be a high demand for a physical supply of natural gas, and it's not going to be resolved anytime soon.
Yeah, I agree. And the more the U.S. exports liquefied natural gas, the higher the domestic price is going to be.
Yeah. Yep.
Are we at a global 5-year low for natural gas inventories? Because you said that U.S. inventories were down 10%, but I think globally it's even worse.
Yeah, well, very few countries have got the natural gas storage system that we have. Canada has some, we have some, but if you depend on, the physical demand for natural gas is extremely seasonal. It's like 30 or 40% higher during the winter because it's the number one space heating fuel in the United States. So we must have about 4 trillion cubic feet of gas in storage before we start the winter. And we're going to start this winter. When we get to mid-November, we're only going to have about 3.3 TCF, maybe 3.4 TCF. So it's going to be tight. We're going to be in mid-November. Our storage level is already going to be where it usually is by the end of the year when we're just getting into the first quarter. So we're starting in the hole. And if we have a cold December, I think you'll see the utility companies will be bidding against each other for physical supply, and that's what runs it up.
Is that also because a lot of other countries still are still reliant on coal for electricity generation instead of natural gas?
Yeah, yes, and also for space heating. They still use quite a bit of coal for home space heating in Poland right now. There's actually lines right now at the coal plants trying to already get enough coal so they can make it through the winter, and it's going to be really, really tough.
Yeah, these inventory numbers are alarming. I just saw another tweet from another energy expert, and he says that we're at 1996 record low inventories globally for diesel and also for heating oil.
Yeah. The inventory report that came out on today on Wednesday from EIA showed that our distillate inventories, now that's diesel and home heating oil primarily, is 21% below the 5-year average. And we use a lot more of that stuff than we did 5-year average. We used a lot of diesel. The reason diesel prices are so much higher than gasoline prices, it took a lot of diesel. Our trucks are running full time to solve these supply chain problems. And also we use a lot of diesel for the harvesting of crops. So the refiners have been focused on producing enough diesel because that was a better profit margin. So the home heating oil inventories are extremely low. I've heard that in the Northeast, quite a few areas are like 40% below the 5-year average heading into winter. So if any of your listeners live in the Northeast, especially, and heat their homes by burning oil, I highly recommend they fill their tanks sooner rather than later. If you wait until the winter storms start coming across your area and you call your home heating oil supplier, they literally might be out of fuel. And when I worked at Hess, we were a major supplier of heating oil in the Northeast.
And didn't a lot of these oil refiners, didn't they also export a lot more diesel because it was even more expensive to other countries? So they were exporting a lot of it. I know the Biden administration was trying to stop that, but I think they were still doing it up until recently.
Well, the Biden administration has done a lot of dumb things when it comes to energy, but I will tell you, I heard today that they're talking about, banning exports. And I don't know if they're just talking about banning exports of crude oil or if they're talking about I think they're talking about banning exports of diesel and other refined products. A lot of countries in the Western Hemisphere, they depend heavily on importing those products from the United States. Just think of it. The Caribbean doesn't have any oil production or oil. I mean, there would be an oil refinery there or something, but they need our imports from the United States. A lot of the South American countries, and they use a lot of diesel down there. So we ship a lot of diesel down there. We ship a lot of gasoline down there. We ship a lot of propane, LPG, liquefied petroleum gases down there, cook with. And they depend on us. And so we just cannot cut this off. If they start messing around with the global supply chain for energy, they're messing around with the standard of living across the world. And they just really need to step back and talk to some people that understand the energy industry and get away from these climate change wackos making all these decisions, because we're talking about throwing a lot of people into some tough situations if they do that.
I'm seeing politics, Trump economics, and
I know.
Well, it's desperation to try to help the Democrats in the November 2022 congressional elections. And we're recording this. The elections are in about a month. We're recording this on Wednesday, October 5th, 2022. Yeah. The Strategic Petroleum Reserve. I mean, Biden threatened today, after the Saudi and OPEC news, to cut by another 2 million barrels a day oil production. He threatened to dump another 10 million barrels of Strategic Petroleum Reserve. But aren't we already down to about half of what was supposed to be in the Strategic Petroleum?
He's already he's already created a national security situation should we get into a war. That's what the Strategic Petroleum Reserve was for. If there was a war that impacted the Middle East so we couldn't get oil from OPEC or North Africa or something, if we were cut off from imports, that's what the Strategic Petroleum Reserve was for, not to lower gasoline prices so you can buy more votes. I mean, it's really crazy. And by depleting the SPR, they're going to prolong this problem. They're going to prolong high prices because they're going to have to refill the SPR. So maybe their goal is make it so bad that it prolongs it, and then they can blame it on the Republicans or something. I don't know, but I mean, man, they are messing with this stuff that they don't really understand how critical it is.
And they won't start buying oil to refill the SPR until at least 2023. I think that's what I heard.
Yeah. But so then they'll extend the problem into next year. And I don't think the situation in Europe is going to resolve itself in the next year. I don't know where this ends, but
well, it would get fixed if they allowed more supply to come online, but we're seeing the opposite. We're seeing nuclear power plants shut down. We're not seeing politicians, bureaucrats, and regulators approve oil and natural gas drilling leases, pipelines, and in the European Union. I think the United Kingdom is starting to talk about fracking, but they don't have the oil service companies and the pipeline infrastructure there. So it's not like this is Texas or Oklahoma where they can quickly bring on new oil and natural gas wells.
Yeah, there's no quick fix for the problem that we're in now. I will tell you that right now. There is a lot of oil and gas under Europe, but they are so again. If you think we're against fracking, they're totally and have been for decades against it. What I cannot understand is how they shut down their nuclear power plants and thinking that wind and solar could replace that electricity. I mean, I don't know what they were looking at, but there was no way with the wind and solar they put in place could replace the nuclear power plants.
Yeah, I agree, especially in Germany, because they don't have the sunlight of California or Arizona here in the United States, and even the solar power plants here in California and Arizona, they're not consistently profitable, and they don't efficiently generate electricity either.
Yeah, that's really one reason I'm extremely bullish on natural gas, because if you ask me, natural gas is the solution. What we should be doing around the world is replacing as many coal-fired power plants as we can with natural gas. That's the short-term solution for lowering carbon emissions. The long-term solution is obviously more nuclear power plants. But if someone decided to build a nuclear power plant tomorrow, it would probably take 8 or 10 years to get all the permits and everything in place so you could actually build it. So there's no quick solution to this situation. But we can't, shut off fossil fuel energy sources for political reasons or whatever until we have something to replace them, unless you want to lower the standard of living for your population. And I hope we learn from Europe's mistakes, because it is going to be extremely rough this winter in Eastern and Northern Europe. I guarantee you.
Well, you have manufacturers shutting down. You have base metal miners that can't afford high energy prices, the value chain companies, so the aluminum smelters, all these base metal providers, they can't afford high energy prices. Other manufacturers can't afford high energy prices. The consumer, if you're in Europe, your electricity bill could be up 10x. So it's crippling the world, the global economy. A modern economy needs cheap electricity. And it seems that the best solutions for cheap electricity are natural gas and our nuclear power. I would prefer those two over coal.
Yeah. We just got to slow this stuff down. I mean, yes, we need it. Yes, we need everything. Our energy plan should be an all of the above energy plan. We can try to shift as much as we can to, clean energy, renewable energy, whatever you want to call it. But it's not going to happen overnight. And we got to be realistic with this stuff. And they need to involve the people that are in the energy business in these meetings, and quit listening to the children like AOC that don't even understand what they're talking about. It's just crazy. I mean, it's just crazy.
Well, trillions of spending of this Green New Deal that she and Bernie Sanders have proposed, a lot of it's corruption. It's going to their friends and family members who are on the board of directors at these green energy companies, and unbidded contracts from the Department of Energy are being funneled, and it's a revolving door of corruption.
Yeah. Well, Jeff Curry, the head guy for Citigroup, their energy expert, he was interviewed the other day. I think it's Citigroup. But anyway, he said that Europe has spent $3.8 trillion on wind, solar, and other renewable energy plans, and they've reduced their dependence on fossil fuels from 82% to 81%.
So they wasted
3.8 trillion. They got nothing for it.
Meanwhile, the executives running those green energy companies pocketed it, and they have yachts and private jets, and they didn't get affected by the bankruptcies in their company.
Yeah. Most of those companies that I've looked at, I cannot understand how they're ever going to make money except for the tax credits.
Yeah, government subsidies. They're relying.
Yeah, government subsidies, the only way they're going to survive.
So I want to transition now to the specific companies. I get asked these questions all the time by my patrons and listeners on the podcast about dividend sensitivity for oil and natural gas companies, pipeline companies. If oil prices, although now we have the oil cuts from OPEC, and we have OPEC production in August totally collapsing by almost 4 million barrels per day, 3.5 million barrels per day. OPEC production collapsed in August. A lot of people aren't talking about it yet. And then the news about the OPEC production cuts. But if oil prices do drop, let's say there's temporary demand destruction, Dan, do you think that how sensitive are the dividends for some of these oil producers and pipeline companies?
Well, I have a high yield income portfolio, and I would say the safest bets are the midstream companies, because they get paid for moving supply. As long as the economy is doing fairly well, and there's no reason to think that their pipelines and their storage facilities and their processing plants are not going to remain full. I see nothing that's going to stop that, even if there was a slowdown in the economy, primarily because we have a shortage of it already. They're the safest. But the upstream companies that I have you mentioned one like Diamondbacks and their Pioneer, I really like a company called Coterra. It's CTRA because they're primarily a natural gas and NGL producer. And I see, a bright future for those. They pay fixed plus variable dividends. So yes, if the commodity prices went down, it would hurt their variable dividend. But based on their last quarter dividends, these companies are paying 10 to 14% dividend yield. And I really like it. And Devon is another one on that list, DVN. Uh, then I also like the minerals companies, and they just get royalties. They don't have a lot of expenses, and so as long as there's active drilling programs on their mineral ownership, they're going to generate a lot of royalties. There's two. Let me click on my table here.
Yeah, I was looking at those actually. There's Cintio, which just bought, I think, did a large acquisition for about $4 billion. So they've been consolidating a lot of them. Yep. Cintio's one.
They're merging with Brigham Minerals, and it's going to create a really strong company. And their dividend yield is like 10 or 11%.
Now, those companies, they don't have the capex that a regular oil and natural gas producer does. But I was looking at their investors' presentations, and they don't like talking about free cash flow. They just mention EBITDA. So they're focused on paying out dividends, which is good for income investors, but they're not generating the consistent free cash flow, it seems, unless oil prices are substantially higher.
Yeah, but they do have some hedging programs to lock some of that stuff in. So they're pretty good, but they have really low operating expenses because they don't drill and complete wells, so they don't have a whole bunch of people working in the field. So they have really low G&A cost.
Yeah, that makes sense. They're very similar to the precious metal royalty and streaming companies, but those companies have even better profit margins because their costs are totally fixed on a royalty or streaming contract compared to.
Okay.
Yeah, so they have more consistent free cash flow. Like a Sandstorm Gold, their costs are $273 an ounce. So even if the gold price goes down to $1,500, their margins are still over $1,000 an ounce.
Pretty amazing when you look at some of the mining companies.
Well, the Sandstorm doesn't mine; they just finance. So when the miners get in trouble, the royalty and streaming companies actually just provide a cheaper cost of capital. So they actually go and buy a stream, and they save the miner from going bankrupt.
Oh, okay.
But with these oil and natural gas companies, are a lot of them hedged? Do they have like 20, 30, 40% of their oil and natural gas production hedged? Or is it the number of the percentage amount of hedges is not consistent for a lot of these companies?
Well, no, it's not consistent for the companies. Like Brigham decided not to hedge, and they were building the company with equity, not with debt. And so they didn't. But most of the upstream companies, they hedge because they're required to by their debt covenants. And so since the balance sheets have been improved so much with this great cash flow they've had over the last, 6 or 7 quarters, they're in much better shape and they're not forced to hedge.
I see.
Yeah. So they don't. And I don't know I can't think of what each one of them does. Blackstone Minerals, which is also heavily weighted to natural gas. Now it is an MLP. It's not a C Corp. So if you're, adverse to MLPs, but they do, right? But they're really big. They're a big company.
Yeah, Diamondback Energy spun off Venom, right? And they're a very large minerals oil and natural gas royalty company, but that's an MLP though, so they're not a C Corp.
No. Viper elected to be a C Corp.
Oh, they changed it?
Yeah, they changed it. They elected a couple of years ago to be a C Corp. Even though it says partners after some of them, they can file an election to be taxed as a C Corp.
Okay, so it's that was confusing. I was looking through investors, but it was confusing then.
Yeah. Another one that is more not real heavily to gas, but it's more a balanced production is Kimbrel Royalty Partners, and that's KRP. And actually, the last time I looked at them, their dividend yield was 12.4% based on their second quarter dividend.
Yeah, so the oil and natural gas industry, I mean, largely they have the better profit margins, the free cash flow. A lot of these other companies and other industries are dealing with high energy and electricity costs, but the oil and natural gas companies, I mean, that's been beneficial to them.
Yeah, and I'll tell you what, these upstream companies like we talked about, Coterra, Devon, and them, they also have aggressive stock repurchase programs going on. And I tell you what I think they'll do. Let's say the commodity prices came down. I think they might back off on their stock repurchases to protect their dividend. Some of them have multi-billion-dollar stock repurchase plans going on right now.
And you said that you think that Canadian oil and natural gas producers are some of the best value plus growth. What are their margins?
Oh my God!
That you cover?
Yeah, I cover some really small cap, the Canadian juniors. Two that I really like are In Play Oil. Its symbol on the Toronto Exchange is IPO. And on the US, it trades on the pink sheets as IPOOF, IPOOF. It is almost debt free. It should be by the end of the year because it's generating tremendous amounts of free cash flow. They were able to make some acquisitions over the last 2 years because they bought these assets from companies that were in deep financial trouble, and so they got them really cheap. And then the oil price doubles, triples, and they look really good. And they are drilling some great wells. And what I like about it, I published a report on it today. They have like 500 low risk, high return horizontal drilling locations that at $80 oil where we are now, those wells pay out in 6 months. Their free cash flow is stunning. And they had 40% production growth last year, probably gonna have 20 or 30 production growth this year. And I think when they put out their year-end report, the stock on the Canadian market is like $3 a share. I did my valuation today, and it looks like to me it's got a chance to go to like $10 a share. It looks really good. So, check out some of them. And another one I like is MidTier Energy. They are debt free. They already pay a nice dividend, and they have steady production growth locked in.
It seems that there's been more mergers and acquisitions in Canadian oil and natural gas companies lately than American ones. Do you think that that's going to change soon?
What I'm seeing, some of the companies that I follow in the U.S. market, what they're doing is they're buying out drilling partnerships. They're buying out private companies that raised a lot of money in 2019, 2020. They drilled a bunch of wells, and people that invest in those drilling programs, they want to put money in. They don't want to keep putting money in. So once they spend all the capital they raise, the investors expect to get steady, quarterly dividends from those companies. So what they're doing is they're selling out to these public companies. They're taking enough cash to return to their investors to make them whole on their original investment. And then they're also taking half the payment is in stock of the public company. So they retain some of the upside with the public company and sell that off. One I really like, and you guys should look at it. It's called Earthstone, ESTE. They've made like 6 acquisitions in a row, and they've gone from last year about 25,000 barrels a day of production. They're going to end this year with 100,000 barrels a day of production. It's a really decent company, and I've known the management team for over a decade. They are a first-class management team, and they are very well funded.
So a lot of the asset purchases, then you would say the last like 4 to 6 months have been done quietly off the stock market exchanges. Then they've been.
Well, they're public companies, so they're announcing them, but it's not the really big companies that are doing it. I'm hearing some rumors that some of the very large companies are thinking about merging, doing these mergers of equals. Now, Coterra was created by the merger of Cabot Oil and Gas and Cimarex, 2 very large companies, and they merged last year at the end of last year. And that is a super strong company, heavily weighted to natural gas. And it pays a nice dividend. Based on their last dividend, it was 11% dividend yield.
So do you think then over the next 2, 3, 4, maybe 5 years that natural gas price will probably outperform the oil price? Or do you think that the oil price will outperform natural gas?
I think the oil price will be higher on a BTU basis. I think gas will probably be in the $7, $8. But let me tell you, if gas is 7 or 8, these companies are going to be making a ton of money. They did not count it. We were stuck in like a $3 gas price for 14 years.
Oh yeah, bear market. Yeah, way too much oversupply. They were flaring off all the natural gas. They didn't have anywhere to store it. I mean, that creates those bear markets. That much extra supply at a loss, that creates a bull market later on.
Yeah, and the gas companies produce a lot of NGLs like propane, butane. All ethane and all that stuff, and those prices have gone up too. So one I really like is Antero. Antero, if you go back 2 years ago, I thought the company was going to go bankrupt. It's that stock's up like over 1,000% in the last 2 years, and they don't pay a dividend yet, but I'm expecting them to announce a dividend program maybe with their third quarter results, because their balance sheet is in great shape now. And they're the largest producer. Oh no, they're the second largest producer of NGLs. They produce over 200,000 barrels a day of NGLs, and very little of it is hedged. And they are making a screaming amount of free cash flow off those sales. Yeah. And they're in the top 5 total gas producers in the country.
For listeners out there who aren't familiar, NGLs are natural gas liquids, and the oil refiners love those because they could turn those into a lot of different products and sell them at a premium.
Right. And propane is a big market. Propane's a very big market. Butane can be blended with gasoline in the winter. And so that's one reason why winter prices are usually a little bit lower in gasoline. But anyway, so there's a big market for that too. It's up there. A lot of blending stocks are NGLs.
Are a lot of these natural gas producers, did they hedge a lot of their production at 3 or 4, or are they now like those hedges are rolling off and they're looking at potentially hedging at much, much higher levels?
Yes, they're one that really looks great to me is Jerry Jones's company. He's the owner of the Dallas Cowboys. He owns a majority interest in a company called Comstock CRK. They had about 50% of their production hedged at maybe like $3 or $4 for this year. All those hedges are gone at the end of this year. Their first quarter results are going to be stunning. They will generate more free cash flow in the first quarter of 2023 than they did in all of 2021, just in that first quarter, because they're going to be totally unhedged. Now, what they're doing is they're hedging with collars. So they have floors at like, say, 5 or 6, and they have ceilings at 10 or 11. So unless the gas price goes to 15, they're not going to lose any money on those hedges. So basically, based on today's strip, they're unhedged. So they're going to get the full impact of those high gas prices.
That's interesting. And didn't he just also IPO in the last couple of years with Jones Energy too?
Well, he sold. He rolled Jones Energy into Comstock, and he got like 87% of the company. And then they sold off most of those assets that were Bakken. They were Bakken oil wells. They sold off most of that. They are pretty much all of it. And they are 99% of their production is natural gas from the Haynesville. And they are in a great position to deal and sell their gas directly to the LNG exporters. I know they've been in contact with the LNG exporters, so they should be getting above market pricing for a lot of their production this winter. And they have a lot of running room. The Haynesville, because of its location in western Louisiana, has got access to Henry Hub is real close. So that hub has got multiple pipelines that can take it all over the country, and they can sell directly to the LNG exporters.
Isn't there also the Fayetteville Shale, I think, in Louisiana too?
Yeah, so the Fayetteville Shale is on decline. It was one of the smaller shale plays. It's not doing very well, but the Haynesville still has a lot of upside.
Okay, well, I think our listeners were given a lot of interesting ideas. It looks like natural gas, and I've been talking about this for 2 years now. I think natural gas, with all that extra supply, all that shale gas being flared off, the switching from coal to natural gas, a lot of nuclear power plants are not being restarted yet in Japan and France, although I think they've said they have plans to. But I think natural gas demand long term, I think it is the compromise fuel for cheap electricity. And it looks like natural gas, along with oil, but natural gas may outperform here in over the next 2, 3, 4, 5 years.
Yeah, operating costs on natural gas wells are much lower than on oil wells. So,
yep. And natural gas seems to be, a lot of politicians are not bashing natural gas quite as much as they are oil, definitely not as much as coal. And nuclear power just has this not in my backyard negative connotation.
I know. Natural gas is the clean hydrocarbon, and it really is. I read a report the other day that said somebody's come up with a way that they can mix hydrogen with natural gas where there will be zero emissions from a natural gas power plant. So if that really works, then that is the solution for carbon emissions.
The major problem for natural gas is how expensive it is for these liquefied natural gas import and export facilities. Really, the governments have to approve all these permits, and the costs are billions of dollars, and it takes years to construct these things.
Yeah, but we got several in the pipeline. We're going to be ramping up to like 20 BCF per day of export capacity. Current capacity is 14 BCF, which is significant. And then we have another 8 BCF of gas that we're selling the pipeline into Mexico. So we are exporting about 20% of our gas supply now.
And the plan is to increase that, is to about double that, I think, by around 2030, right? Yeah. By about 2030, I think the plan is to about double the liquefied natural gas exports here in the United States.
Yeah, I agree. There's a bright future for the natural gas producers.
Well, yeah, Norway, we didn't mention this earlier, but Norway is really benefiting from exporting oil and liquefied natural gas into European Union and Germany.
Yeah, and they're going to get a high price for it this winter, that's for sure.
Well, Dan, you are a wealth of information for oil and natural gas with your experience, and this is all you do. You cover oil and natural gas full time. If my listeners want to check out the Energy Prospectus Group, how do they do so?
Well, we're a subscription-based service. It's just $350 a year, and if you can't make that much money off some of our ideas, then I'm doing something wrong. We have 3 model portfolios. And then the ones, especially for our high yield income portfolio, I believe they're super strong balance sheets. They've got more than enough cash flow to maintain their dividends. And anyway, you can go to our website, just energyprospectus.com, or you can send an email to energyprospectus, one word, at gmail.com. That's energyprospectus@gmail.com. And that goes to Sabrina. She handles our member services, and she can tell you how to join. And again, it's just $350 per year. We have a monthly newsletter, but we send out individual company reports with my independent valuation. The companies don't pay me a dime for those reports, so it's my independent valuation of the company, and we don't handle anybody's money. I don't have different accounts with people. So this is, our members are what I call self-directed investors, and they use me as a way to do their due diligence on these companies.
And your model portfolio, so you have the Sweet 16, which is mid-tier oil and natural gas producers. Then you cover small caps, which are the high upside ones, your 5-baggers, your 10-baggers with a lot of growth. So you're looking for good risk reward there. And then you have the income portfolio, right? Yeah.
And I tell you, I've never felt better than I do right now on our small caps. They're all doing all of our small caps right now are free cash flow positive, and they're trading at a deep discount to any reasonable valuation if you believe oil's going to stay at 80 or above.
Yeah, I remember when the oil price was around 120, 130 with Russia and Ukraine, and the oil stocks were only valuing 80 oil, and now oil was it got a little bit below 80 briefly, and then the oil bears were saying the oil caps were correctly valued. I didn't think at the time that they were correctly valued. I think the market wanted them lower. I think a lot of people wanted oil and natural gas lower, so they didn't want any energy exposure. I don't see this problem going away. I think there is still big supply side problems, Dan, for oil and natural gas. Look at OPEC. I mean, there are big supply side issues with OPEC, the OPEC producers, CapEx issues. We see it on the private sector side too. A lot of these oil and natural gas producers, well, not necessarily natural gas, because we do have some natural gas well growth, but especially for oil, they're not making the big CapEx investments into future supply growth.
No, I'll make a prediction right now. I'll tell you right now, when the SPR draws stop, and they have to stop pretty soon, when that stops, oil will go quickly over $100 a barrel, and it probably happens before December.
Good for oil investors, bad for consumers.
That's right. Yeah, but we're down here. We're still at about $3 a gallon. We can live with that. It's
you're in
like
Texas,
Europe.
so it's cheap. Yeah, you're in Texas.
It's cheap. It's cheaper down here, I guess. But go to Europe, man. My son lives in Europe. They're $10 or $12 per gallon right now.
And that's why they have cheap subsidized public transportation, trains, and buses.
Yeah, they have to.